Hello, everyone, and welcome to Theory into Practice. Today, we are going to talk about a little bit about resilience, about some stuff that's happening around the country. And hopefully, I'm very happy to have our next guest. We've actually been going back and forth a little bit. I've actually known who he is for a long time, come across him at conferences, never actually had a conversation with him. But Dr. Daniel Kaniewski, welcome to Theory into Practice.
Thanks for having me.
I appreciate you taking the time. It means a lot. I know you've been busy back there. I know you've been doing some interviews on a larger scale as well with some of the with the hurricanes back to back. But I wanted, before we get started into that, to give you a chance to just tell everybody who you are, what you do, and a little bit about your background.
First, it's a pleasure to be here. I know your audience is largely emergency managers, and I certainly count myself among them. So thanks for this opportunity, and thanks for what you're doing for the emergency management community. I've been in this field for 20 some years. I started as a firefighter paramedic in a small town in Minnesota and ended up here in Washington, D.C., working primarily on policy over the last 20 years or so of my career, and have had the opportunity to serve in government a few times at the White House and most recently at FEMA, where I was the Deputy Administrator for Resilience. And I know we'll get into that today and about how FEMA is really focusing a lot more on resilience these days. And I'd like to think that I played a role in that.
I'd like to, I believe you have, and I think resilience is one of those areas, and it's one of the things I want to talk with you more heavily about today. Is it's one of those words that comes about, right? And not everybody really understands it. They don't know exactly what it means. It has different definitions, just like emergency management does to so many different people. What does resilience really mean to you?
I agree. There are many definitions out there. In fact, over a decade ago, when I was at a think tank, we had a task force on resilience. And the first question that came up was, how are we going to define it? And it became quickly apparent to me that we could spend the entire time, all of the meetings, just debating the correct definition of resilience. And so I'll say the same thing I said back then, I'll say today, which is it really is about any action you can take before disaster strikes. It's, of course, resilience, and at its heart is the ability to withstand some kind of disruption and bounce back quickly. And for us as emergency managers, I would like to think that we define it in very practical terms, right? And so we shouldn't worry about if our definition is slightly different than someone else's or another industry defines it somewhat different. For us, I think it really is all those pre-disaster actions. And when I got to FEMA, it was from the practical aspect of resilience there was all those pre-disaster programs, they really didn't have an organization that fully encapsulated them in the same way that response and recovery does. So the Office of Response and Recovery at FEMA, it's pretty apparent what they do. It's everything during the disaster and post-disaster. But there was a scattershot of programs at FEMA that did various aspects of pre-disaster programs. And they fall into, I'd say, three major categories, certainly from a FEMA perspective, but I would argue largely from the emergency management community at large, which would be preparedness, hazard mitigation, and insurance. And you can almost look at those three as the three pillars of disaster resilience, as I've called it before. And again, certainly from an emergency management standpoint, I think that's a very practical way of defining resilience, is looking at it from those three angles.
Yeah, it's one of those things too. So I've been doing emergency management for more than 17 years now, and I've personally have made the change to where it is that I like to spend my concentration and try and put the majority of my efforts, and it is in the mitigation, in the preparedness, and ultimately as well prevention. You know, how prevention's heavily tied to terrorism. But ultimately, if we can prevent something from happening by taking action with mitigation and preparedness, then we're definitely going to be more resilient when and if the thing happens, right?
100%. You're absolutely right. And I would say, yeah, the natural disaster equivalent of prevention is mitigation. You're stomping out that risk so that event never actually materializes.
Yeah, I one of the things too that I want to say preach, the word that comes to my, I want to preach, but I don't like that word so much, but I like to be the voice of, is emergency managers are not first responders. We're a response mechanism. We're secondary, tertiary, but we need to get into the role of being in all the phases. We need to work in those phases, but we need to be effective in those phases as well. And I actually, in my new role, one of my new roles that I'm actually taking on right now, I'm a resilience coordinator for a small city here in California. And California is actually implementing it's a new program trying to, I guess it's a pilot program, ultimately to try and get more positions on resilience within these different organizations and jurisdictions. But what I've found over the last year and a half, as I've kind of taken on this role and really tried to champion it, is everybody's definition is different. They're thinking climate change, they're thinking, some of them are thinking sustainability. So, and it's a mixture of all those things and how we operate. But I think the biggest part of it is the cooperation and the partnerships that you build in order to establish that type of resilience. What can we do greater and I want to say as a nation, but more worldwide, can we do to really put ourselves in a position that when the bad thing happens, we take the steps needed to become more resilient? Because there's so much stuff that, and I know you're very familiar with this. It's hard to get people to spend money on something that hasn't happened, or that you can't prove that you say that you ultimately did the thing that stopped the thing. That's, when it comes to mitigation, preparedness and prevention, you're spending this money here. You don't have anything to show for it, even though it may have actually very well limited the effects from the cause of the event. How do we shift that mindset and that line of thinking because we're throwing money at response because we see it. It's there. It's in front of us. Lights and sirens and the things on TV. And we see the winds and the fires, and we can see it. So they're like, yeah, let's throw money at it. How do we get the mindset to shift? Because as you've mentioned on many different interviews, that $1 spent on prevention or mitigation saves $7 to $14 somewhere on the response side of things. How do we make that shift? Because I found that's to be the most difficult, because we concentrate on what we see.
That's right. And I agree. And it sounds like you're encountering some of the same challenges that I did, right? In my career, we had different careers. When I was in policy at a think tank, we were debating the definition of resilience. And it sounds like in your communities, you're working with other stakeholders, you're saying they define resilience differently. What does that mean? And so I think we've both come to the same conclusion, which is we need to be practical about this. And we need to say, whoever these stakeholders are that care about reducing future disaster impacts, we need to put them under this tent. We need to be working with them, either formally or informally. They don't have to be in your chain of command. These can be other stakeholders that you're coordinating with. And they could be in government, like you described, or they can be in the private sector. What I found where I am now is in the insurance industry. I'm at Marsh McLennan, which is the largest commercial property and casualty insurance broker in the world. And so I look at it now from an insurance angle, and I say, insurance, that's a key stakeholder for resilience. In the same way that hazard mitigation reduces the physical risk, insurance reduces the financial risk. So you have to look at this in an ecosystem approach, whether it's at the local, state, or federal level in government, like I did at FEMA and like you're doing now, or it's in private industry. And you say, in the insurance industry, or maybe if you're in the finance industry or the real estate industry or all these other adjacent industries, you say, how can I play a role in reducing those disaster risks? And how can I work with other industries and with government to determine how best we can make these investments? Because you're absolutely right. We know that for every $1 invested in hazard mitigation saves $6 when a disaster occurs. And more recently, with the U.S. Chamber of Commerce and Allstate, they took a look at the economic benefits of insurance, or excuse me, of hazard mitigation. Of course, there's economic benefits of insurance too, but of hazard mitigation. And they found that it provided an additional 7-to-1 benefit, right? So you add the 6-to-1, the 7-to-1, you get to 13-to-1. So you can keep demonstrating these benefits. The key, I think, to the heart of your question is, how do we get others to buy into this? With hazard mitigation, there's empirical evidence. We have the data, and the analysis has been done by the National Institute of Building Sciences, by Allstate, and in the Chamber more recently. But what about preparedness, right? We know, just because as emergency managers, we know the value of preparedness, but it's harder to quantify. And thus, it's harder to convince maybe investment in that area. And with insurance, there's a number of disincentives for individuals and communities and governments to take what they should do, which is take out insurance, because they wrongly, in many cases, believe that the government will be there, right? That the government is the insurer. And It's simply not the case, certainly not for an individual. The FEMA individual assistance programs pale in comparison to an insurance product, whether it be homeowners or be flood, which is also offered by FEMA through the National Flood Insurance Program.
That's one of with my approach anyway, has been more because everybody's vast definition of what they think resilience might be or what it is to them is to basically tailor and my approach into their definition of it, and know that the overall vision of what we're trying to do is the same, which is, as
I like that,
trying to prevent or make it be prepared for or be able to respond better or recover from much easier and quicker. And I have it back here, which is anti-fragile, right? One of the things I talk about with resilience is not just bouncing back better than we were before, but how we do that. And that's what kind of my approach when I do things. But one of the things that I love that you mentioned is, and I like to talk about the insurance, because we find that it's not, there's the education there and the information is not necessarily there, but you find people too that just can't afford it. And how do we overcome that? And how do we educate the communities that they need the insurance and how they can get it in a more affordable way?
That's right. And I think there's starting to be general consensus around the fact that insurance is the best option. Now, it's the best option if it's affordable and available, right? And in various circumstances, it may be, there may be challenges around either availability or affordability. And if you first look at governments, so you think, are governments insured? Or local governments or state governments insured? Yes, there's a variety of insurance that those governments hold, whether it be property or casualty or other. But you also look at the disincentive built into the system for a local government to insure its fire station or to get property insurance on its schools. Because inherently, if there is a major disaster, the president declares a disaster, then those entities will be eligible for FEMA public assistance. That FEMA public assistance is provided at a minimum of 75% of their losses, right? They're getting at a minimum 75%. They're on the hook for at most 25%. And they've paid nothing for it. There's no premium associated. A local government's not paying FEMA on a regular basis a premium to receive that payment. And then they get that payment if a disaster occurs up to an unlimited amount, right? They get reimbursed at whatever their losses were. So that sounds a lot like insurance, doesn't it? And unfortunately, what that does is it creates this cycle where local governments and state governments are becoming more and more dependent on the federal government and transferring less of that risk to the private sector. And so what does that mean over time? It means ballooning budgets, especially the disaster relief fund. And it's becoming unsustainable because the American taxpayer is now on the hook for all of these disaster costs that are, from a government standpoint, local government standpoint, are insurable. They're just choosing not to buy insurance for some of these programs, or because of some of these programs like FEMA PA. Now, at the individual level, and that homeowner or that renter, it's a little more complicated. It really depends on the particular location of that property. Is that property subject to flooding? If so, you should get flood insurance. But if it's not just subject to flooding, but it's subject to flooding regularly, it's not something that has never happened before. It's something that happens regularly. The National Flood Insurance Program prices according to risk now, which it historically hadn't, at least not at a granular level. It was almost like if you were in a flood zone, you had higher premiums, and if you were outside a flood zone, you had lower premiums. The new FEMA NFIP risk rating 2.0, it prices basically on the risk to your particular structure, to your home. And there's been a lot of backlash on that because some of these homes that are at high risk, they're seeing their premiums go up over time. Now they're capped year over year, the amount of increase. Nonetheless, they're seeing those homeowners in high risk flood areas are seeing their NFIP premiums going up. That said, those homeowners in low risk areas should be seeing their premiums go down. So it's a reality, I would say, that NFIP has started to accept, that FEMA has started to accept, which is there can no longer be broad subsidization of flood insurance premiums because it's becoming so expensive. And the National Flood Insurance Program is over $20 billion in debt. That's with a B, right? With no hope in sight of getting out of that debt. And so clearly something has to change or needs to be reforms to the National Flood Insurance Program. But more generally, if we take a step back, we look at, I described some of the challenges about getting local governments, their property insured. We just talked about some homeowners, and how it might be challenging, a challenging environment to get flood insurance. And then homeowners is the other piece. Homeowners insurance has gone up in many areas. It could be because of disaster risk. It could be because of inflation, like we're facing on everything we buy these days seems to be going up in price. Or it could be because of other reasons specific to a particular state, because insurance is regulated at the state level. So when you talk about homeowners insurance, it really depends what state we're talking about, the regulatory regime, about the disaster risks, and about the particular aspects of that state. So yeah, while there are challenges associated with each aspects that we just talked about with insurance, the reality is the best thing that a homeowner can do, a renter, a local government, or a small, medium, or large size business can do is make sure that they're insured against the risks they face. Because if they don't, the alternative is much, much worse. The alternative is that you will not be made whole as a result of your loss. And the result is you could be set back years or decades or may never recover from the financial consequences of that disaster you experience.
Yeah, I appreciate you saying that, because one of the things that I've noticed anyway is you get these specifically in areas where like they were a homeowner, are a homeowner, and they had land and then they paid it off, but then they just like, well, I don't need insurance anymore, and then they lose it. And I have personal family members that have done this, and then you lose it, and then the home, there's nothing there. There's no, you can't be made whole. But when in a larger, and this is from smaller incidents like house fires and stuff like that. But when you're thinking about a disaster and you still have that mindset throughout the entire country that, oh, FEMA is going to come in and they're going to give us money. It's minuscule compared to what you would be getting with an insurance.
That's right.
You have an insurance policy. Where's a lot of it? And I know we've tried to go away from this in the past, but it doesn't seem like it really took, is that getting away from FEMA as a bank. Right? They think, oh, FEMA's just going to come in and give us some money and we're going to be okay. Or they chase FEMA around the country trying to grab onto that funding. How do we get away from that? That's a mentality, because you see a lot of these individuals are repeat offenders, or I say repeat victims, or participants in this, because they just stay where they are, or they don't move, or they're just like, oh, we'll be okay because I'm going to let FEMA come in and give me some money. How do we get away from that mentality?
Yeah, unfortunately, FEMA has this reputation as they're the federal government's ATM, and they're going to be there and give you cash if you experience a disaster. And some of that, of course, is true. FEMA does provide assistance through the Individual Assistance Program and does provide assistance through the Public Assistance Program. But for the individual, that, as you said, that assistance pales in comparison to what they would get from insurance. And it's one thing for state and local governments to become dependent on the federal government and becoming dependent on those FEMA programs to be reimbursed after disaster, as opposed to taking out insurance. That's one thing. But what's the most devastating to, and frankly, it hurts every time it hurts me to see this every time there's a disaster, which is individuals wrongly become dependent on those kind of programs, on those federal programs like the FEMA Individual Assistance Program or NFIP. So you mentioned there are certainly circumstances where individuals choose to live in risky areas and, let's say, at risk to flooding. And historically, their National Flood Insurance Program premium didn't fully reflect that risk. And so they had these subsidized premiums living in these risky areas. And then risk rating 2.0 comes around and suddenly their premiums are going up. And they're surprised by that, and they're upset about that. And rightly, I can understand by being upset if you didn't know your risk. But many people did understand their risk, and they either chose not to do anything about it, or they couldn't afford to do anything about it. So if you're a low-income household living in a flood zone, even if you knew that your rates were heavily subsidized and that the rates could go up at some point, there probably wasn't much you could do about that, because you couldn't afford to mitigate that flood risk. Elevating your home is it's an expensive proposition. And so where you see FEMA stepping in and attempting to address this issue is by linking risk reduction with risk transfer. Said differently, it's pairing hazard mitigation with insurance. And so that same program, NFIP, that where premiums are going up, that same program also has a grant program called Flood Mitigation Assistance, FMA. And FMA provides funding to local communities and to households to take those mitigation actions to reduce their flood risk, because that's not only good for that individual homeowner, right, to help them mitigate their flood risk so they don't have to endure repeated flooding. It's also good for the federal taxpayer and for the National Flood Insurance Program, because they realize, especially with those repetitive loss properties, that it is going to continue to cost FEMA and the American taxpayer more and more and more in the future as those properties continue to flood. So why not do our best collectively to reduce or ideally eliminate that flood risk?
Yeah, that's a good point. I guess it could be a rumor, but I've seen it and I've heard it throughout the country, is that insurance companies are either raising prices so high that people can't get the insurance in for a specific area, right? Like earthquake or fire or flood. In California, it's fire right now. That's the big thing. We're not going to insure you for fire. How do we work around that, or how do we fix that aspect of the potential of not being able to get insurance because it's either not offered or it's priced so high that we can't get it? Maybe are there efforts that we can take as individuals to better prepare our properties, our day to day on how we respond or interact to be prepared and trying to mitigate against these things?
Yeah, I think that's exactly, you hit the nail on the head. It's about preparing for and mitigating against these disasters. That's going to help not only you reduce your insurance premiums, but it will also help you and your family and safeguard you when something bad happens. So again, with insurance, if we're talking about individuals, you have to set flood off to the side because it's such a different animal, because that's a federal program. And we talked through some of that. So let's talk about homeowners insurance now. Homeowners insurance, it's regulated at the state level. The rates that homeowners insurance charge is approved at the state level by the state insurance commissioner, right? So there is a insurance commissioner in each state that regulates the insurance market, all types of insurance, including homeowners insurance. And so the insurers can't, and again, I'm saying this outside as a non-insurer, right? So the company that I work for does not underwrite insurance. We're a broker. So I don't want my comments to be construed as speaking on behalf of an underwriter, right? They each have their own underwriting algorithms, and they determine what kind of risks, they're willing to take. Because some insurers won't take a certain risk because they've already underwritten too much of that or enough of it from their portfolio. It's too risky for them to do it. And that could be by geography or by peril, but it's something that each insurer has to determine on their own about what kind of risk do they feel comfortable underwriting. And then the second question would be, how do they price that, right? And again, each of them has their own proprietary underwriting methods, and each of them are required by law to stay separate, right? So insurers are not allowed to talk to each other about how to price these policies. That's an antitrust statute that prevents them from doing that. And it's, again, insurance is a very heavily regulated industry. But if you look at kind of generalities, like what would an insurer look for? If you mentioned wildfire risk, no doubt that the insurer would look at, I'd put them in two big buckets. One would be your structure, and the other one would be everything surrounding your structure, your community, what type of vegetation is nearby, et cetera. And they're going to take all of that into account. So there are some things you can control and some things you really can't. Like if your home happens to be located in the middle of a forest, your fire risk is probably going to be higher than someone who's in the middle of a farmland. I think that's obvious. That's something you really can't do anything about if that's where you live. The part where you can do something about is your structure. And so if you look at that, there are a number of relatively easy and low cost things you can do to reduce your fire risk. And one, talking about vegetation, removing the vegetation from around your house, making sure that you have a fire break around your house, that vegetation isn't there. And then there's other things you can do that require more of an investment, such as building materials, roofing materials, windows. And I'd recommend for anybody who's looking at these various options about whether it be to safeguard your home and your family or to reduce your insurance premiums, because really either of those, whatever your priority is, you're going to accomplish both by taking these actions, right? You're going to both safeguard your home and your family, and you're going to provide an opportunity to have a reduction in premium by taking those actions. I would encourage anybody to go to the IBHS website. If you're familiar with IBHS, the Institute for Business and Home Safety. And IBHS is a nonprofit that's funded by the insurance industry. And it's funny, it's actually the Insurance Institute for Business and Home Safety. We just call it IBHS. So we're very transparent. I think the insurance industry and the nonprofit are very transparent about where they get their funding from. And the reason I tell you this is because we in the insurance industry see the benefit of a research institute like IBHS testing building materials, seeing which ones best withstand a particular peril, like wildfire, and then providing that information at no cost to the American public and to builders and to anyone who's interested in fortifying their home against these perils. Because we know, the insurance industry knows, and I think emergency managers know, that the better materials, that the more disaster resilient materials that are used in any particular structure, home or otherwise, it benefits all of us. That reduces losses. It reduces loss of human life, reduces financial losses, reduces insurance payments. It reduces disruption in your life following a disaster. And that's the definition of resilience.
Very cool. I like that. Thank you. Before I let you go, I want to talk about briefly so we just had the two back-to-back hurricanes, and there's very little time to do anything. You can expect it. With hurricanes, they're coming. You have time to prep. You have time. But when you have two back-to-back like that, and it's not the first time in history that's happened, obviously, but a lot of people are affected by this. A lot of people didn't. Same thing, right? That we always hear. We didn't think it was going to happen that bad. Didn't think it was going to be that bad. Didn't think it was going to be so quick or be so strong. How do we continue to grow the message of really being prepared for these types of things, or how to enforce that infrastructure so that when something like this happens, it's not completely destroying or delaying a community for a lot of this is going to be years and years, but being able to get back to at least functional quickly. One of the things that we've seen is the length of time that people are going without being home, without being able to operate businesses, without being able to do really anything in that area. Now we're all about response and now recovery. How do we continue to develop that and grow and advance in that area, especially when a lot of these areas too, they don't implement mitigative or preventative measures when they're doing the recovery.
That's right. Yeah, at this stage, for those disaster survivors from Hurricanes Helene and Milton, you're going to see those with insurance are going to bounce back more quickly, and they're going to be made whole, whether they're individuals or businesses. Those without are going to have a long and difficult recovery, is the sad truth, because they're going to be dependent on their own savings. They're going to be dependent on the support of friends and family, of philanthropic organizations, and of the government, federal, state, and local governments. And hopefully, together with all those stakeholders supporting those disaster survivors, those survivors will bounce back eventually. But it's going to be a much, much more difficult path than those with insurance. So that's why it's so important before a disaster, as you said, that we try to reduce the risks as much as possible. And hazard mitigation and preparedness are two great ways to do it. Local government officials have so we were talking about what can individuals do, but what can local government officials do? What can they do to help their communities ahead of time? One, it would be accessing the federal funding that's available through, such as the BRIC program, the Building Resilient Infrastructure and Communities Grant Program. Those are pre-disaster hazard mitigation funds that are available to any community in America to help build in that resilience, to help repel any type of disaster that may hit that community. But beyond just federal dollars, and we shouldn't always focus on what the federal government should be doing to help communities. That's often a focus. We should realize that local officials actually have a lot more power than they may realize to reduce these disaster losses. And I'll give you two examples. Building codes. Building codes are generally determined at the local level. Yet 2/3 of American communities do not have a strong, disaster resilient, modern building code. That's a shame.
Yeah.
So one of the first steps I would suggest a local official take to protect themselves and their communities is get a strong building code. Get a building code that's appropriate based on the risks that are faced in that community. And if you see like Florida has a very strong building code. And you see those structures that were built after that building code came into effect, they survived these disasters. The damage was relatively minimal. In Florida, again, with probably one of the best building codes in America, they realized that the risk isn't the same everywhere, right? You need to have the code needs to get stronger. In Florida's case, the stronger the wind is going to be, right? So they have a great approach to not only a statewide building code, which is frankly a rarity, right? Where a state takes on the responsibility, but then looking at particular areas within that state that need an even stronger code than others. So that'd be one. The second would be zoning laws. So if building codes are the how you build, zoning laws are the where you build. So let's not encourage development in areas that we are known to be disaster risk, at high risk of any kind of disaster. So whether that be a flood zone, it's frankly ludicrous to be doing any kind of development, residential or business or otherwise, in a flood zone, because it's only a matter of time that area is going to flood. And so let's avoid developing those high risk areas. And the same could be said with other perils, but I think flood is the one that you see is the most notorious, where a local official, and I think you and I understand this, which is a local official wants to be friendly to development, to developers, to businesses. They want to grow the economy. What's the unfortunate part about this is that local officials are often only thinking about what's happening in their term. And in their term, their couple of years that they're in office, they may grow the economy by encouraging development and giving even subsidies to businesses to develop in these, frankly, risky areas. But it's only a matter of time that disaster happens, and it may be long after they've left office, and that those homes, those businesses are wiped out by a catastrophic disaster, but one that frankly is predictable. Because if you look at the high risk flood area, the 1 in 100-year flood zones, which I hate that terminology because I don't think it means anything to anyone, but that's saying it a different way would be 1% chance every year. And maybe that makes a little more sense, right? If you think of it this way, that local official that encouraged development in that risky area, and if it's on that 1 in 100-year flood zone, every year there's a 1% chance that there's going to be a flood. And over time, those 1% catch up, don't they?
Yeah.
And pretty soon it becomes inevitable. And then you have all of that goodwill, all of that economic development is all, not only is it all lost, but as you and I both know, it's even worse because you've set people back potentially, like we talked about, years, decades, their whole life, because a local official made a decision to develop an area of land that never should have been developed.
That's a fantastic explanation. Thank you so much. I think that, and it's done so much throughout the country, and it just does a disservice to the community in which you're supposed to be serving. And that was fantastic explanation. Thank you so much. Where can people find you? If they want to connect with you, I know you're on LinkedIn. I know you have a website, danielkaniewski.org, which I'll put that in the show notes as well. Where can people really connect with you?
Yeah, I'm most active on LinkedIn. It's my only social media that I really keep updated and active on. I like to post any kind of thought leadership I see out there. So for example, when that Chamber of Commerce all-state report that highlighted the 13-to-1 benefit of hazard mitigation, that would be something that I would highlight, right? So if you like that kind of stuff, connect with me on LinkedIn. My website, I don't keep updated quite enough. So I'm more focused on LinkedIn these days. But Daniel, I appreciate everything you're doing and getting out the message to all of emergency managers so that they can better understand the actions they can be taking to better help their communities become more resilient.
Appreciate that very much. And it's being able to talk with individuals like yourself that keep me going with doing this and learning. I learned a lot today. a lot to take away and ultimately apply in what it is that I do. And hopefully those who are listening and watching will feel the same way. I undoubtedly think that they'll be able to learn and apply what you brought to the conversation today. Your time, as I mentioned to everybody, your time is your most valuable asset, and I appreciate you giving me some of that today. And anything I can do for you in the future, please feel free to reach out.
Thank you, Daniel.
For all those who are driving, listening going down the road, I will have the connection. I'll have his LinkedIn, I have his bio, everything in the show notes. Please feel free to reach out to me at any point in time. Always looking to do great things and to bring on new guests. My goal is for us to get better, and let's do so together. I'm Dan Scott, and I will talk to you next time.